Residential mortgage loan programs are designed to help individuals purchase or refinance a primary residence. It also applies to owner-occupants purchasing a second home or a vacation home. On a side note, an investor may choose to purchase or refinance a rental property in their personal name instead of a company, as residential loans typically offer lower interest rates on loans and may allow the borrower to make a lower down payment as opposed to a commercial loan. They are typically limited to a conventional loan, and up to 75% of the rent or projected rent can be used to help the borrower qualify for the loan, which would positively affect the DTI calculation. These residential programs can vary widely, but they generally fall into a few main categories. The approval criteria, such as DTI ratios or credit scores, vary between the programs. We're not going to get into the deep details as part of this training, but it's good for you to know that someone could qualify for one program but not another based on the individual approval criteria of each loan type. A basic familiarization of these loan products is all you need. Now let's touch on about a dozen of these so that you can be well equipped to talk with realtors and borrowers. Bank statement loan. A type of loan where the borrower uses bank statements to verify income instead of traditional documentation, often used by self-employed individuals or those with irregular income. The look-back period is typically 24 months. Construction loans. A short-term loan for an owner-occupant used to finance the construction of a home. It covers costs like materials and labor. It's typically interest only and will normally convert to a permanent mortgage once the construction is complete. Conventional loans. These are not insured or guaranteed by the government and typically require a higher credit score and a larger down payment, typically 20% of the purchase price. These loans are subject to the private mortgage insurance, or PMI, that we defined earlier when the down payment is less than 20%. FHA loans, insured by the Federal Housing Administration. These loans are designed for first-time homebuyers and those with lower credit scores. Borrowers can make a down payment as low as 3.5% of the purchase price. These are the loans that are subject to the mortgage insurance premium, MIP, that we defined earlier. Home equity line of credit. A HELOC allows homeowners to borrow against their home's equity up to a certain limit, similar to a credit card, with variable interest rates and flexible repayment terms. Home equity loan. A loan that allows homeowners to borrow a lump sum against their home's equity, usually at a fixed interest rate, and repay it in regular monthly installments. Jumbo loan. A type of mortgage that exceeds the conforming loan limits set by the Federal Housing Finance Agency, FHFA. These loans are used to finance luxury properties and homes in highly competitive real estate markets. Bottom line, they're large residential loans. Refinance. A loan that replacing an existing mortgage with a new one, typically to secure a lower interest rate or monthly payment, change the loan term, such as from adjustable rate to a fixed rate, or to access home equity with a cash-out refinance. Reverse mortgage. A loan that allows homeowners aged 62 or older to convert part of their home equity into cash without selling the property. Stated income loan. A loan where the borrower declares their income without providing traditional documentation, often used by self-employed individuals or those with irregular income. Not many lenders allow this, but Lormax does. USDA loans. These loans are backed by the U.S. Department of Agriculture and are designed for rural home buyers. They often require no down payment and have lower interest rates. Again, we're talking about residential home loan products. USDA loan does not mean that the borrower has to buy a farm. VA loans. Guaranteed by the Department of Veterans Affairs, these loans are available to veterans, active duty service members, and certain members of the National Guard and Reserves. They often require no down payment. However, the borrower is typically subject to paying a funding fee unless they receive a waiver due to an approved VA disability rating. And to round out our residential loan types, Lormax offers a foreign national loan product. Foreign national loans are designed for non-U.S. citizens who want to purchase property in the United States, typically requiring higher down payments and interest rates compared to conventional loans. Well, folks, that wraps up our lessons on residential loans, where you received information on property and mortgage types, the information needed for a residential loan application, and the typical residential loan programs. Remember, the initial definitions and formulas are interchangeable regardless of dealing with residential or commercial discussions. Next series will discuss commercial lending products.